it was great that you reached out to me. If you hadn't reached out, we wouldn't be sitting here today. And it occurred to me when I was thinking of putting together the agenda for today's, or the weekend's meetings, that we've had a few authors here in the past, actually. We had Will Thorndike here a few years ago, who wrote a very influential book for many of us, The Outsiders. And in hindsight, I'm like, why on earth didn't I get him up on stage to speak with him? And thankfully, I didn't make the same mistake this time. So you wrote a wonderful book, which I read earlier this year, called Capital Allocation. This is the book. And there's plenty of copies here, so Jacob's going to do a signing in the break afterwards. But before we get to the book, I'm sure many of the audience here don't know you, Jacob, so why don't you introduce yourself?
Yeah, I'm Jacob McDonough, and going to Omaha for the Berkshire event's a lot of fun. You see a lot of celebrities, and Rob's one of them, so I got to see him and bump shoulders with him there, so that's good. But I'm from Grand Rapids, Michigan in the U.S. A year and a half ago, I went off on my own to manage capital for outside clients in a separately managed account structure to keep overhead low and, give myself as long a runway as possible, but eventually would love to go to the fund structure when the time's right. In May 2020, I published a book that we're going to talk about, Capital Allocation. I took the point of view of a practitioner, someone who would love to create a company like Berkshire, and I think there's a lot of opportunity actually to do that still today, especially in areas like Japan. So I wrote the book, like I said, from a practitioner. In 1965, what could an analyst have seen in the financial statements, in the annual reports of Berkshire, the companies they acquired, companies they invested in? I read as many books as I could on Berkshire and Warren Buffett, and I was disappointed there wasn't as much financial data as I wanted, so I had to hunt down the annual reports, financial statements, and that took a lot of time and energy in libraries and some other investigation. And I figured some readers would want to see that data and might not have the time or energy to hunt that down. So I figured it might be a good project to turn into a book. So
we're already getting towards the book, but yourself, what were you doing before you started your partnership?
Yeah, so I went to Michigan State University, studied finance, and moved to Nashville, Tennessee, and worked for a great investment research firm down there, New Constructs. We didn't manage money ourselves, but we built models for 2,000 companies. My job was to dig through 10Ks, 10Qs, try to find interesting things in the footnotes, non-recurring charges, and try to see where reported accounting net income maybe didn't match the economic reality of the business. So that's where I got my experience.
It sounds a little bit like the Karate Kid, where you have to polish the car 100 times to the left, 100 times. A lot of grunt work, but then maybe at the end of the process, you're a pretty good investor.
Yeah, so I enjoy now investing, studying, deeper dive on smaller number of companies instead of, trying to manage 2,000 or so.
And the question I love to ask is, most people come to value investing more through kind of like a very suddenly, as opposed to it being something that sort of gradually creeps up to them. And we talk about the aha moment. Was there an aha moment for you with investing?
Yeah, I'd say when I was young, just learning about compound interest kind of got me excited, knowing that it wasn't just about a salary. As long as you saved money, started early, and owned equity, salary didn't matter so much. So when I was sitting in school, that was kind of nice to know. From there, eventually just a love of studying businesses kind of is what really drove me towards this line of work.
Did you come across the Buffett letters at some point in the journey? Or?
Yeah, exactly. In college, yeah, Buffett letters and reading all the books I could on there was a big head start.
Awesome. So let's turn to the book. So how did the book come about? Where did the idea come from?
Yeah, so I tracked down the annual reports, like I said. I was going to do that anyway, and it took a lot of time to find them, especially in the 1950s, 1960s. And a lot of the companies they acquired, See's Candy, National Indemnity, the Illinois National Bank of Rockford, I thought they were private companies. I've never really seen any data on them before the acquisitions in any of the other books, but hunting through libraries, through the Moody's manuals, there was decades of financial data on those companies even before he acquired them, so it was great just to see the lead up. Buffett always talks about flipping through Moody's manuals, so sitting in the library, you kind of can picture him flipping through the Moody's manuals just like you and imagining maybe what he was looking at the time.
Yeah, Matthias might be getting excited that it sounds like there's a business in reselling some of those old manuals for Moody's.
Definitely.
In very broad strokes, 'cause obviously I'm guessing a lot of the audience won't have read the book. For those of the audience who, I assume everyone knows Berkshire Hathaway, but just broadly, in very broad strokes, what is the book about?
Yeah, so the book starts 10 years before Buffett took over Berkshire. So those 10 years, I focus on what Berkshire was before he got involved. And then the next 20...
So just for context, he was managing a fund at this time, and he actually bought Berkshire Hathaway as an investment in his fund, right?
Yeah, he was an emerging manager, like a lot of people in this room. Ran a fund for about 12 years. Before fees, I believe he compounded at a rate of 31% per year with no down years. So pretty successful. He closed the fund in 1969, but through the fund in 1962, he started buying Berkshire stock, continued buying it. In 62, Berkshire had a valuation of $12 million. I think the valuation got up to $16 million by the time he finished accumulating shares in 1965. And by then, I think his fund owned 65% of Berkshire, and he became chairman in 65.
Yeah. And the book describes obviously the initial investment in Berkshire Hathaway and various investments he made subsequent to that.
Yeah, that's right. Yeah, Berkshire was a very bad business, even worse than I would have thought beforehand. It's a commodity business with no brand or differentiating aspect to it. Some commodity businesses can be good if they're the low-cost operator, but even in the annual reports prior to Buffett taking over, management was very clear that they were not the low-cost operator. Their Japanese competitors had much lower cost structures. The workers in Japan were paid 15 cents per hour back then, and it was $1 per hour minimum wage in the U.S. at the time. And the cost structure just didn't work in the U.S. anymore compared to the competition overseas.
So it was a terrible investment, so there's hope for all of us.
That's right, yeah. It lost money a lot of years. Every once in a while, though, they'd have a few profits through the cycle. But, yeah, a cycle of losing money and a couple years of it looking okay.
Yeah. So he took the money out of Berkshire, a failing business, and allocated it into much better business. What were some of those businesses?
Yeah, so what I was most interested in is seeing how do you do that? How do you take capital out of a textile manufacturer, and how do you move that into new businesses? So in 1965 and 66, his first 2 years he took over, they actually had some profits, which a small part of that might have been just the timing of the cycle. They had some profits, but he cut costs in a major way. In 1965, cost of goods sold declined by 10%, which 10% might not sound too crazy, but in terms of overall dollars, it was major. So it was a very low margin business, so that means revenue compared to profits is very high. Revenue compared to their valuation is very high. So any little piece of any sale that you can keep to the bottom line in addition is very meaningful. So 10% cost of reduction in cost of goods sold was huge. So they profited like $4.5 million of net income of pre-tax income in 65, $5 million of pre-tax income in 66. So that $9.5 million of pre-tax income, was a major portion of the $12 million valuation that it had in 62 and the $16 million, I think it was, valuation in 65. And so he had tax credits as well. They had losses in the years leading up to it. The tax credits were going to expire in the next 5 years, but luckily he had profits those 2 years, so it was tax-free. So that was really, $9.5 million of free cash flow in his first 2 years was a major portion of, his purchase price he got out of textiles. And any other textile manager would have put that right back into the same old business, but what he did was, how he got capital out was when they had profits, he avoided reinvesting, and he got that elsewhere. He started first, he had a stock portfolio for a few years, I think 3 years. He doubled his money there, which is nice, and then he moved that money into National Indemnity and the Illinois National Bank of Rockford were his first two big acquisitions.
So the first two big acquisitions were an insurance company and a bank.
Yeah, that's right. And they're really interesting acquisitions to study because I was really confused about float before writing the book, honestly. just how aggressive could you really be with the float? That capital, it seems like it could be redeemed if you have some major losses on policies in certain years. So I was curious, they seem very conservative, and I was just wondering from my point of view, how could you, sleep well at night? How aggressive could you get? And so what I really learned is, they talk all the time about how they can use float to buy stocks and private businesses, but that really wasn't until much later in the 90s and early 2000s through today. They definitely can, but that's really just because of their size. They're so diverse, so big that they have earning streams coming in outside of insurance that now they can do whatever they want with the float. The railroad was actually purchased through an insurance company, Burlington Northern, and that's unheard of in the insurance industry. I don't think anyone else could really do that, not too many other players.
But just so everyone understands, the float being the premiums that people pay for insurance, and it's the money they have at their disposal to do whatever they want with.
That's right.
Yeah.
Yeah.
So describe one or two of the acquisitions which you thought were the most interesting. Maybe bearing in mind that the audience, not everyone here is going to be an investment professional, so just at a high level, some of the acquisitions and what made them, what you learned from them, what you found exciting about them.
Yeah, I really liked the Rockford Bank that he bought. So it was very unique that in Illinois at the time, there was a state law where a banking business could only own one branch location. And so, there's not much growth opportunity for the Rockford Bank. They only had one location, but it makes a good situation for Berkshire where they could take their profits, just send them to Omaha, and Buffett could reinvest it there. But it's very interesting because they had huge economies of scale. You wouldn't think a one-branch bank would have economies of scale, but what I learned is economies of scale kick in at different levels for different businesses or industries. It's not the overall largest dollar amount of revenue gets the economies of scale. It doesn't really work that way in banking. The Rockford Bank, with one branch, they had about $100 million of deposits in the 70s at one branch location. Adjusted for inflation today, that blows anyone out of the water today of any bank. And today you have, internet banking, mobile banking. You'd think there's less need for branch locations, but the Rockford Bank blew them out of the water. And if you think about it, if you jump from 50 million in deposits to 100 million deposits, and you're not adding any locations, your costs are not doubling. You shouldn't have to double your staff or your equipment. So non-interest income as a percent of income kept getting lower and lower through the years, and so profit margins kept going up and up at the Rockford Bank, which is fascinating. And there's some small banks today that you can see parallels to that. So economies of scale at a bank are at the branch level, and then also it's how much work you can do per employee, how efficient you are. How much leverage you can leverage per employee is where economies of scale come in, and it was interesting to learn in that acquisition.
Yeah, that was one of the most important lessons I took away from your book, was how laser-focused Buffett was on finding cash. He didn't care if the business could reinvest that cash. That didn't bother him if there were no additional branches Rockford Bank could open, because he could take the cash and invest it himself. What were some other examples of that?
Yeah, there was so many. I was a little surprised at the valuations because when he talks about his young days, it's a lot of obscure names with incredibly cheap valuations. I saw a lot less of that in this period, but a lot more examples of companies that they were great businesses, consistent businesses, but they had way too much cash on hand because they had nowhere to put it. So See's Candy had maybe half their assets were cash.
See's Candy, the West Coast confectioner.
Yeah, that's right. He tried to acquire Detroit International Bridge Company, a toll bridge, which to me was fun to look at because he always talks about a toll bridge as an ideal business, and he almost bought one, but someone outbid him there. That one was another one where they weren't going to build another bridge, so they had nowhere to reinvest their cash, and they're sitting on half their assets again, where maybe cash. And there's a lot of examples of overcapitalized businesses where that's why I think Berkshire as a structure is underrated, because it's very tough to find companies that can compound consistently for 70 years, 100 years. But if you had a Berkshire structure where it doesn't, you can have a business that can't keep compounding, can't keep reinvesting, but if you're able to move that capital and compound it somewhere else without having to pay dividends and get taxed on dividends or realize gains by selling a stock to buy another one, the structure itself, I think, is a little underrated.
And another feature that jumped off the page to me when reading your book was it's not just about finding companies with the cash. it's having the possibility to get your hands on that cash.
Yeah, that's right. And maybe that's why in his early days he really focused on small companies, because then maybe if he could acquire the stock, then he had the potential to take over the business. You know, if he was buying the stock of the largest companies back in the day, you know, he might not ever have a chance to actually acquire the company. So in your letter, like you said, you know, if the stock goes up, he could sell it. If it didn't, he could take over the company. And I think that's why he focused on, you know, smaller companies back then. But you did have a question yesterday. Someone in the audience had a question on, can you have an edge on small companies versus large companies? And it's interesting to see in his early days, he did look at a lot of small companies, a lot of obscure companies. But even when he moved capital out of textiles in the 60s, he had a portfolio there for 3 years. Disney was in there, and American Express, and Wrigley Chewing Gum. They're a lot smaller than they are today, but I mean, back then Walt Disney was a celebrity. Disneyland was open in California, and I believe Mary Poppins had just come out. That was a kind of a worldwide sensation. So it was a big name. It was not very obscure at all. So he was very opportunistic. You know, he was willing to. I feel like he didn't follow any rules. It didn't have to be below book value, even back in the 60s and 50s.
Yeah, that's a wonderful thought. And you know, another thing is, when we talk about it, it sounds like everything was perfect, but he also had his rough patches.
Yeah, he definitely did. And that's why I love studying history, because it helps put into context what we're going through today. That brings me comfort. But in 1971, Blue Chip Stamps had a stock price of, I think, $19.75.
19 or 90?
19.
19, okay.
Yeah, but 3 years later...
I love the way you know the cents as well.
I
20 would have...
That's right. And 3 years later, though, the stock price was 77% lower. So they went through a very tough time.
77%.
77%, yeah. And in 73, they were down like 53%. The next year, down 28%. So back-to-back years, very tough declines. And Charlie Munger was the chairman of Blue Chip back then. The businesses, Blue Chip and Berkshire, were, you know, they were intertwined, but that's kind of why they had to merge later into one company. But at this time in the 70s, they're separate public companies, but very intertwined. Buffett and Munger definitely worked together. But, you know, I'm sure Warren Buffett wasn't yelling at Charlie Munger. He didn't fire Charlie Munger with a 77% decline in that time period. But, you know, it's interesting to think how much they've accomplished since then, you know, getting past that rough patch. But most importantly, I love looking at the valuation at the time in 74. That's where it was an extreme bargain, whether you want to look at earnings or assets. The year before, the valuation of Blue Chip was $23 million back in 1974, so much smaller than what we're talking about today with Berkshire. But the year before, they earned $8 million. So at the time here, they're selling less than 3 times earnings. It was understated net income as well, because 2/3 of their assets were in stocks, you know, which they are long-term holders of stocks. So on the income statement, you don't get the benefit from those assets every year unless you realize the gain. So $8 million of net income was mostly through See's Candy, the candy company they owned. And so cheap on earnings. But then on the asset side, 2/3 of your assets were a stock portfolio managed by Warren Buffett and Charlie Munger, legends who already had a great track record. And yet, I believe the price to book value, they're trading below 40% of book value. So a discounted assets, when the assets are managed by some legends, it was just an insane valuation back then. So it's always nice to know markets can do crazy things. It's guaranteed that they'll do crazy things from time to time, and it's guaranteed that stock prices go down, not just up all the time.
So having looked at all of these investments, what was the most important lesson you took away?
For me, staying flexible, staying opportunistic, because there's plenty of times where, you know, I mean, textiles is a good example. He pulled money out of textiles. Not many people would do that back in that time period. But there was other examples too. They got into Westco Financial, a savings and loan business, and really within a few years, they really pivoted that business into many other things. So they were very quick to see if they had a mistake. Within a few years, they weren't afraid to admit that and change their ways. And, you know, Westco was another one where they kind of got out of that business. That's not one where I think they were planning on it right away, but they stayed flexible and opportunistic, and I think, you know, weren't very rigid on rules or, following the original plan they had, they were willing to change.
Yeah. Flexibility is definitely key. Lots of books get written about Warren Buffett, about Berkshire Hathaway. Very few of them actually get sold at the Berkshire Hathaway shareholder meeting. It's an enormous compliment to you and to the book. How did that come about, though?
Yeah, so that came about because right before I published it, I sent a message to Warren Buffett's secretary, just because I have quotes from Buffett in the book and quotes from annual reports. So I want to make sure it was okay. Within one business day, they responded. I'm a random person. They're busy with hundreds of thousands of employees. One business day, they got back to me, asked me to send me the exact quotes. One business day later, they approved it. And then I asked if I could mail a couple books to their office. 3 months later, I got a nice little note from Mr. Buffett inviting me to sell it at the meeting in a few nice words. So it's incredible that he took time to do that and that they were quick to respond to me. I don't think many companies would do that. So,
what a wonderful story and a wonderful guy. So what good things have come of the book?
Well, this is definitely one. This is this was a surprise. But yeah, I got to meet a lot of nice people. It was a lot of fun putting the book together. It's tough to start when you're staring at a blank page, but the ball kind of slowly gets rolling the more you write. And then by the end, I didn't really want it to be over, so I thought I'd write another book, but I'm all out of ideas right now, so I don't know if that's actually going to happen. But
fantastic. So we've got about 10 minutes time for questions from the audience. If my microphone assistants are here. Who'd like to ask? There's one at the front there.
Hi, thanks a lot for the book. I'm just wondering, did Buffett have to buy National Indemnity and all those companies that he bought early in the years through Berkshire, or does he have a lot of cash on the side that he could buy, out of his personal accounts? Like, why was it structured in a particular way?
That's a great question, and in the book, that's a main reason why I wrote that I thought buying Berkshire was a mistake. Buffett said it's a mistake. Now I'm second guessing that. I think it's a lot more nuanced than that, but to your point, one reason why I thought it was a mistake is because he was running his fund, BPL, and they bought 65% of Berkshire. So if they didn't do that, BPL could have bought 100% of National Indemnity. National Indemnity is very valuable today, so him and all his partners could have owned basically everything you see today instead of just 65%. So Buffett, could have made something of himself. Could have been a lot richer if he didn't do that mistake. But
thank you. Who else has a question? Kevin? Oh, sorry.
Hi.
John at the back, yeah.
Thank you very much. Nice speech. And I wanted to know from the teachings of Buffett, I basically something that shocked me when I was learning the way he was thinking about investments. It was through the practice and his own words, he sometimes mentioned that the less risk you take, the more rewarded you are, right? So maybe that is similar to the opportunistic thing you have mentioned also, but have you noticed this practice on being less and less risky rewards you more and more?
yeah, I think that's a great question too, because I don't, I'm skeptical that risk and reward are maybe as tied as some people teach, but they were very, very conservative if you compare to a General Electric or a lot of other conglomerates or insurance companies back in the day. They were very conservative if you look at leverage. I mean, they did take out some debt, but it was always very modest. And especially in the insurance business, you can get into a lot of trouble, more from like operating leverage if you have too many premiums written compared to the capital you have on hand. And at Berkshire, they were always very conservative on that basis. Before they bought Geico, or before Berkshire acquired stock in Geico, that was one example where they wrote very extreme, when they almost got went into bankruptcy, and that was because they wrote an extreme amount of premiums compared to the capital they had on hand. They were very over-leveraged, and Geico had 28 straight years of underwriting profits, one kind of bad year in year 29, and then year 30, they were just about bankrupt. So if you take on too much risk, even the best of businesses, just with one hiccup, can get into trouble. So he was very conservative, and yet I'd say his returns were still excellent.
Kevin?
Yes. How did writing the book change your approach to investing?
I'd say I really enjoyed the process of hunting down the annual reports, and I enjoyed flipping through Moody's manuals. And since I had fun doing that, I try to keep that in my research approach for finding companies. I don't really like using screeners. I really like flipping like A to Z on a group of companies. Whether I enjoy Japan, so there's a Japan company handbook, and you get to flip through that book. It feels kind of fun. It feels like you're flipping through a Moody's manual. So I feel like maybe it changed me in terms of the research process. And then also just learning a lot about the businesses helped as well.
At the back there, Alex.
Yeah, thank you for your book. I'm looking really forward to read it. I wasn't aware of it, so this is a plus of this meeting. Thank you. I did something similar to you. I read in parallel many books on the 70s period of Warren Buffett. And when you petition value investing first time, you get this article on Forbes that he says he feels like an oversexed guy in a whorehouse. And you have the feeling that this was the best time of his life, But when you start reading the books in parallel, you discover that Munger basically is heavily down on his own investments. Some friends of him have to liquidate his fund because they over-leveraged. Rick Guerin was over-leveraged, so Buffett took over shares from Rick Guerin in Berkshire. He had an SEC investigation in blue chip stamps that did consume a lot of time. There was the Omni affair in National Indemnity, where there was a risk that he had to put lots of capital into National Indemnity, and he was probably the only guy who could do that at the time. Then later on, Washington Post, where there was a strike, and they burned down the newspaper facilities. So in hindsight, you read about that, and it was the greatest time that he had, but in that moment, it was pretty stressful. So I thought it would be a good thing to write a book about Buffett's toughest moments, because everybody writes about his track record and says he's the best in the world, but I think he had a lot of stress during his career, and maybe this could help also people like us who from time to time run into stress.
Yeah, that's a good idea. And I think his excitement in that period was when I described the blue chip valuation, how low it got. When he would think about that, I think that got him really fired up. That was the excitement part. But you're right, there was a lot of stress outside of the financial statements, outside of the valuations at the time. So the valuations got him excited, but yeah, they're definitely tough times. But I think how he got through that, he set up his life that worked for his personality in terms of his day-to-day, his office. So, because the important part of compounding is if you have a very long runway. Munger's 99. So if you can manage your stress to have a very long runway, then it really helps.
I love the idea of a book about Buffett's tougher moments. It's also a reminder, I think, when people look at the past at some of the crazy share prices and the opportunities, and it kind of, in hindsight, it looks very easy, but as we all know, when those crazy share prices happen, it's normally because there's some kind of stress externally or at the companies, and so it's never as easy as it looks in hindsight. Yeah. I think we've got time. Oh, we've got a few more minutes. Yeah. Is there any other questions? Right at the back there.
Thanks for the talk. I really like your command of the numbers. We're all trying to learn from the best investor probably of all time. What would you think or say are the things that we probably can't replicate from his success? Because there's probably things we can learn, but what would you say we probably can't copy?
Yeah, that's great, because earlier in my talk I said I would love to replicate the Berkshire model, and the important thing to distinguish is not the returns, The stock price that Berkshire had over this period was 26% compounded over the 20-year period. And I don't think it's very smart to start with like a goal of trying to achieve that, because he is a genius. So I think lowering your expectations is huge, but the structure of the company itself, if you lower your expectations much further, still has a lot of benefits towards like lengthening the runway that you can compound at a business, even if you're just talking 10%, 12%, 15% instead of the 26 and 30% that Buffett did. That would be the main thing that I think only Buffett did. And then the other thing we're lucky with is that only Buffett could have been maybe the first person to do this, but now that he's kind of paved the way for other people, that also helps for people who might be a little more mortal.
Who else has a question? While you're thinking, maybe I'll ask another question then. Especially for the emerging managers here, a lot of them will be looking to enter the industry through some kind of a fund structure. That's also how Buffett started, but he ended up, investing effectively through a company. Now, obviously, there's lots of regulatory and tax considerations around that, depending on where you're based. But just let's leave those aside. But just at a high level, which is for you the optimal way to go?
In terms of structure? Yeah. So yeah, he did do a fund, and I think from the very early days, and he started with very, very low AUM. So I don't think maybe that's a good lesson not to get down if you're starting with low AUM. That's exactly what he did too. But I think you do have to structure it a little different in the early days if you do have low AUM. I went the separately managed account structure because there is less, in the U.S. at least, there's less costs involved and a little less regulation. So just maybe going that structure first to keep costs low. I think in Buffett's day, costs already were low and regulations were less, so he had less to worry about and could do more of a fund structure from day one. But I think that might be the main point to take there.
There's a question from Chandon here at the front.
Thanks for coming. It was great to hear you. Why stop in 1985?
Good question. 1985 is when the textile mill closed down, and so I thought it would be fitting to show the change from 10 years before he took over all the way until the original business was dead. And I said it started with 3 failed businesses. Blue Chip Stamps was a rewards program for retailers. Hot Chow Cone was a Baltimore department store that was bought through an entity called Diversified Retailing. And by 1985, all 3 of those businesses were extinct, basically. Blue Chip Stamps was still hanging by a thread. Their revenue dropped over 90%, so it was basically done with. But the textile mill was completely shut down. Hot Chow Cone was out of business completely. And so trying to see the change over those 2 decades by the time the original businesses were dead, and then just trying to figure out how do you get to a $700 billion market cap today with those struggles is important to look at. And if you look today, I think Berkshire is number 6 in terms of market value worldwide. Only one company ahead of them was in existence in 1965. Saudi Aramco apparently was founded in the 1930s, the Saudi Arabian oil company. But every other company ahead of them are tech companies that were invented, created after Buffett took over. So he blew past any other company that was around in the whole world, starting with 3 failed businesses, which to me is the most incredible part of the story.
It's incredible, yeah. Then maybe another question from me. The type of investments Buffett was making, or the type of the opportunities he had in the sort of 60s and 70s, do you see that type of opportunity anywhere else today?
Yeah, I do. And I think anywhere around the world, you do run into companies that are great, consistent, and run out of opportunities to reinvest. So there are overcapitalized businesses really anywhere. Where you get into trouble is you might not really be able to do anything with that because it might be founder-led or there might be reasons they need to be overcapitalized. But I do like the valuations in Japan. A lot of companies seem overcapitalized there, and the valuations seem lower. And just when I flip through the Japan Company Handbook, it just really reminds me of the research I did in my book. It seems like a lot of parallels there.
Yeah, a lot of people, probably in this room as well, have spent a lot of time looking at Japan, given how low the valuations are. A lot of companies with more cash on the balance sheet than the theoretical market cap. But especially after reading your book, it struck me if you don't have a method or like a path to get to that cash, then it's really just theoretical. It's that situation could persist forever.
Yeah, that's right. Yeah, so it's a big red flag if the company has very high insider ownership and cash has sat on the balance sheet for decades. There's a very little chance there's anything you can do with it, and the cash might stay there for many years. So with a lot smaller AUM, if I do look at a place like Japan, I know I'm not going to take over anytime soon. So it's definitely look for companies where you're happy with what management's doing, you agree with what they're doing, and you're in a lot better shape then.
Awesome. I think we have a question from the internet.
What was the most difficult part about writing the book?
Most difficult part, besides hunting down the annual reports and financial statements, was questioning if there needed to be another Buffett book. There's so many books already written about Warren Buffett, written about Berkshire Hathaway. I didn't want to step on any toes of what's already been written and covered really well. So over time, I was questioning if there was really a need for an additional book, but I'm happy I went through the process.
Awesome. Question there?
Regarding Japan, do you have any recommendations how to approach those companies? For example, I invested in a company called Shinnecoin Group. It was basically a compounder, perfect stock to just fire and forget. Of course, net cash and stuff like that. They did buybacks, so the management showed some shareholder alliance, and then the company was taken private. So, shit. And it seems like a paradise, but a hell in the same way.
That was the Japanese Warren Buffett.
Yeah. So, I'm just curious, how do you approach, or what do you look for management stuff in Japan?
Yeah, I had a similar experience too. There was a company I enjoyed as well that I wanted to hold for a long time, and it did get taken private. And so on one hand, when it's taken private, maybe that's validation that there was some value there, and that obviously someone wanted to buy it. But I do know when I speak to people that invest heavily in Japan, they do preach patience, and so it might not work out in every case, but it's definitely at least a pond worth fishing in. But
thank you.
Okay, we've got time for one last question, I think. Maybe up the front here. Oh, sorry, there's someone already has them. I'll try and get to you if this is a short one.
Sorry, I would like to ask, since Berkshire is successful history, there are a few companies in the world that try to replicate what Berkshire does. Do you think that there are some successful companies that can make it? Thank you.
yeah, so there have been companies that have tried, and there is a few that have some success. Markel is one that would come to my mind, but they, I believe, were in existence long before Berkshire themselves. So part of the way they modeled their company, I'm sure, was their own decision, but I'm sure they were influenced by Berkshire over the years as well. So Markel's been successful, and there has been a few other companies that have tried and maybe not found so much success too. But I do think I'm just surprised not more people have tried. But I'm struggling to think of too many besides Markel that have had success.
Okay, Luca, one last question.
I assume, maybe wrongly, that you do not speak Japanese. How do you evaluate management of Japanese companies?
Yeah, that's a good question. I only know English, and I feel guilty about it as I travel through different countries here. But no, a lot of people stay away from Japan because, like you said, the language barriers, and that's definitely, it's something I'm personally comfortable with, just because if it was apples to apples, I would love to just own a company that's right next door to where I live, and I could meet management and all that. But it's not exactly apples to apples in terms of valuations and the opportunity set, so that's kind of what leads me to investigate there. And the only way I deal with it is trying to use multiple sources for multiple data sources. So if I'm using one, trying to find multiple other translations maybe to compare to, so you're not just relying on like a Google Translate. But I have found a lot of companies report their investor relations website in English and Japanese, and you know, have found plenty of websites that have decades of financial data that they translate into English. And you know, technology is improving in terms of translation technology, and who knows, maybe that chat GPT, whatever, might be able to help me someday as well. So I try to use more and more sources to make up for, instead of just relying on like one translation, I guess.
I really enjoyed it, Jacob. It was a wonderful talk.